Hi, Brian. Thank you so much
Hey,
for being on today. I think this is such an interesting point in time and wanted to have a good conversation with everyone about credit and alternatives. If we look at the last few weeks, one of the big things that is in the news is software stocks, and it's not so much equities, it is the new advances we've seen with Claude. We've seen AI who can now code with just AI, without humans. And we saw a collateral impact a couple weeks ago. The software stocks sold off significantly. They've been down, and then there became some concerns about private credit because software, I think, is about 12% of the private credit market. And I don't think this is going to be something a one and done. I think we're going to see a lot of disruption this year. So I'm kind of curious how you're thinking about that event specifically, but about private credit in general.
yeah, no, thank you, and it's super interesting. And I just want to, before I dive into private credit, I just want to say it's fascinating because our platform we invest across the life cycle of investments from early stage venture capital to late stage venture, where Claude Anthropic is today, and then through late stage buyout, public market, private credit, etc. So we have investments with exposure to Anthropic on our platform, for example, and that's a conversation for another day. But private credit in general has gone from being a niche strategy to sort of an asset class, right? So, private credit used to be, if you were early to private credit, you could be incredibly selective on what assets you're lending against and whether most economic storms events, with a much smoother and higher return stream than can historically have been obtained through liquid or traditional credit markets. So what's happened as credit has continued to take in a lot of money is, you're seeing a compression of that premium that you can earn, and you're seeing managers become more susceptible to these sort of market cycles and market movements in asset classes such as software, right? So it's incredibly interesting to watch in real time. I still think that publicly traded software companies they're not pricing in bankruptcy yet, right? Which is when credit managers start to take losses. So a lot of these companies are still trading at very lofty, you might say, revenue multiples or earnings multiples. So, but yeah, private credit is 100% more susceptible to these market swings.
Yeah, and I think you bring up a really good point about whenever you see big inflows that are coming into a category, and like even if I think about COVID, a tremendous amount of money came in to kind of the middle of the country to multifamily housing, and that really compressed returns, and we've seen that happen over the last several years, and then real estate might be in a healing process now, but it's not unusual to see an asset class really bloom and then see those returns compress. I do think thinking about disruption in general, because again, I think this is kind of the first landmine that we've kind of seen. I think we're going to continue to see disruption in ways that we can't predict. But how do you think about like duration being a positive in that category?
It's an interesting point on multifamily because I have a friend who works for Berkadia, which is one of the largest commercial real estate brokerages. He's specialized in the South Florida uh, multifamily team, and they made baseball caps when they sold a property at a three handle cap rate. Coincidentally, that happened to mark the top of the I think of the multifamily market, but it's a perfect I'd say analogy for just the cycles and capital chasing returns. And what I would say about liquidity and private credit is that private wealth products tend to be evergreen in nature, and I'm always thinking about liquidity. And when you're taking assets that are private and putting a semi-liquid wrapper around them, it's something that adds a whole new set of risk factors versus the underlying assets. When you have these mature institutional investors with large investment teams that are able to use actuaries to sort of try to project their liabilities and like when they need liquidity, et cetera. And that's not even to say they get it right, but all the time. But the point is that private credit is the asset class where I have the least concern about that mismatch of the underlying assets and the liquidity, because if you speak to most private credit managers, they will tell you, look, we're making 5-year loans. That means we're going to get about 20% of our book back every year. In practice, those numbers are closer to 25 to 33% of their book maturing every year. So you have regular way loan maturities, but you also have companies being sold, doing refinancings, etc. So I think it actually, most private credit funds offer 5% per quarter of liquidity, and it just aligns really nicely with the underlying assets. So I'm less concerned about private credit than I am with real estate or private equity in these sorts of structures.
And I think that's a really good point about duration being short, because as we are thinking about disruption, and you brought up a good point with the publicly traded firms, like a lot of these software companies have their multiples have compressed and the stocks have come down, but they're not pricing bankruptcy. Whenever you have disruptions, you have these immediate reactions in the market. But if a company really were to be displaced and go away, it takes a long time, right? And if you've got an asset that is debt, you're investing in debt, and the duration's not that long, there's a lot less risk than maybe what the market is suggesting.
Oh, 100%. Now, a lot of people who like to pick on private credit will talk about extend and pretend. But I guess when you start seeing outflows, you can't extend people, right? If you have the liability going out.
The other thing that I think is probably important to talk about is due diligence. So we talked about how much this private credit has expanded, and how many players that you have in the market. And one of my favorite books of all time is When Genius Failed, which if people have not read it, it's a fantastic book, but it really talks about a model that worked really well in the debt market, then was moved over to the equity market, and it blew and levered up to the hilt. I think at the peak it was 98-1, and then blew apart. And the thing with private credit that I do think is interesting is you have all these teams that have extensive track records, like in equities or other areas, that are now moved into the fixed income area, and they haven't necessarily been through a credit cycle before. And to me, that's where I worry about exposure. And so I think the due diligence side is really critical, and I'd love for you to kind of talk about how we're looking at due diligence when we're looking at managers.
Yeah, so when we're looking at managers, again, private credit is the most commoditized asset class within alternative investments. Capital is a commodity, right? So what we're looking for when we're looking at these managers are scale. We one of the managers we work with, one of the guys who is the head of their group, he started his own private credit firm. He raised $1 billion. They got it to $3 billion. And if you talk to him now, his old firm is sitting at $6 billion, and I remember he was telling me, again, this is a $300+ billion firm, that that his old firm can't compete for deals, right? So what you want to look for are managers who have long tenure, right? Scale to have people in originations, and as well as dedicated workout portfolio management teams who can deal with credits that things don't go as planned. One thing I love to see from teams are origination professionals who they sort of get paid based off of the life cycle of the deal, not just once the deal closes, but they firms who want to see compensation for those professionals tied to the performance of the deal until maturity. So again, we're looking for scaled players with deep teams, and this private credit, in my opinion, is not an asset class where you want to reach for an extra 0.5%, right? It makes sense just to be invested with the largest, most institutional scaled players.
I mean, scale is critical, especially in that particular asset class. The other thing that I thought might be helpful for us to talk a little bit about is diversification, which is a simple concept, and people mention it all the time. Diversification is feels less important when everything's doing well, and or when you're in an environment where a handful of investments are kind of driving performance. And I think that's all starting to change now, and we've kind of seen it a little bit in 2026. So I'm kind of curious, when you think about alternatives, how do you think about diversification, especially from a diversifying risk?
Yeah, so look, when an institution allocates to an asset class, right, they never pick just one investment, right? So if they're creating a vintage program, for example, where they're committing to an asset class on an annual basis and legging into it over time, they're making a portfolio of commitments every year. So that's a really important distinction versus what you see a lot in private wealth, where people it feels like are looking for solutions, right? And a lot of products, could conceivably be used as solutions, and everything's probably going to end up okay from a strategy perspective. But if you take strategy aside, you still want to eliminate the single manager risk from a flows perspective, right? So you can invest in a secondaries fund or a private credit fund that's multi-manager, diversified across hundreds of funds, thousands of portfolio companies, but you still have single manager risk that fund could get, right? So what I would want to see is, having a handful of funds for each category, right? So our current limits are 20% to alts, 5% on a position level. But, if you were going to create a sort of asset class sort of breakdown for alts, right? Just call it 5% to private credit, 5% to private equity, 5% to real estate, 5% to hedge funds. I would want to see a handful of funds at least in each category.
I think you bring up a good point about a lot of times people are trying to solve for a problem at one point in time and not think beyond that. And I think that's something that comes up quite a bit. On the subject of errors, like what is something that you see what is something that happens more frequently, a mistake that a team might make that you would want to share with others for people to avoid?
Never fall in love with a manager, right? You always got to be ready to pull the trigger, right? If facts change, and hit the eject button. So at the end of the day, all of these managers there's a reason they want to go through fiduciaries. It's to limit their own liability with individual investors. So, right, never forget, right, like we're the last line of defense and probably the first line of liability.
Yes. I think that's probably the most important point. Thank you so much, Brian, for sharing your thoughts. Really appreciate it.
Yep, thanks for having me.